Hello, welcome to Market Avenue. My name is Edward Nyakun. To tame inflationary pressures in developed economies, countries like the UK Central Bank has hiked interest rates to 0.5% as against 0.25% in last year. And this is increasing cost of borrowing and therefore squeezing business ability to expand and engage more hands. We're going to find out more from Polapia Konedu and Kojokusi, a financial analyst based in the UK, as to how these moves by the central banks are going to impact on our part of the world, especially the Ghanaian economy and Africa. But before we continue, let's speak the busy language for today. Let's go to the Ghana Stock Exchange to find out more from Sani Abdurrahman about the performance of the equities market.
Well, Edward, it's the second straight session where the market has ended flat. It means the market didn't see any price mover today, and consequently the market indices have also remained unchanged. It means if you have invested on the Accra Bears since the start of the year, your return is in the negative 3.35%. The financial stocks also giving a negative of 1.57%. If you want to know cumulatively the volume of shares that were traded as at the end of the session, 1.2 million shares, which resulted in 232,000 Ghana cedis. And that's the composite index as a result of the fact that there hasn't been any price move on the market today, remain at 2,695.91 points. The market capitalization has also not seen any change, remaining at 63,369,000,000 Ghana cedis. If you want to know the counters that recorded some activity, they were exchanged across 12 counters, largely driven by CalBank. Of course, since the start of the week, we've seen CalBank making a lot of moves, but the equity is yet to record any price change, and that has resulted in the equity not pushing the market indices to go any further. If you want to know the rest of the equities that made some moves, 25,708 in Bell, MTN, which has been the driver of the market for some time now, traded 16,353 shares as at the end of the session, 1.1 million in SIC, but there was no change in price, either decline or appreciation. That has resulted in the market indices remaining unchanged. 231 in total and as low as 246 also in Societe Generale. Edward, if you ask me what transpired on the market today, that's all I can tell you.
Thank you very much, Abdul, for that update from the Ghana Stock Exchange. We'll be right back, joining via Zoom with Polapia Konedu, standing by, an economist, and Kojokusi in the UK financial analyst. Hello, welcome back to Market Avenue. Paul Apia Kunedu and Kojokusi. Guys, you're welcome. I hope you can hear me. Paul and Kojo. Kojo, can you hear me? Kojo? Paul, can you hear me?
Hello?
Yes. Kojo, if you can hear me, why are central banks all over the world, especially the UK, we've heard the Central Bank of England increasing the interest rate to 0.5% as against 0.25% in 2021.
Hello, can you hear me?
Yeah, I can hear you. Why the hike in interest rate?
Hi. So, okay, can you guys hear me?
Yes, I can hear you.
I think it's quite difficult hearing you, but from what I got, you are asking why central banks are increasing interest rates.
Huh? Yeah, go ahead. Hello?
So, if I can chip in on that issue,
Yeah.
why central banks are increasing interest rates. So basically, across the world, due to supply chain disruptions, that is due to the COVID pandemic that happened, due to skill shortages, due to skill shortages, they are very, very good. Yeah.
I'm listening. You can go ahead, please.
Hi. With the shortage in goods and services, what transpires is that there's more money chasing fewer goods. That leads to inflation. And where there is inflation, one of the main policy tools that the central bank has is to increase interest rates or hike interest rates by some few basis points, or depending on how severe it is, then it really go up higher. So that is what is happening now. So you hear bits like Federal Reserve increasing interest rates, Central Bank of England going up, Bank of Ghana. So that is what this is all about.
All right. Now, Paul, one would ask, what would be the impact on consumers within those countries, that space, and even businesses?
Okay, so
let's take it from Paul.
England,
Paul.
It depends
Let's move
on
to
what
Paul.
type of business you are involved in.
Hello, Kojo.
So, for instance, if you are a bank, then you know your profits will go up. But if you are an average business, then the cost of borrowing is going to go up for you. So the impact for businesses and for even individuals is that mortgage rates will go up, credit cards rates will go up. That leads to less savings because your disposable income is quite reduced because the prices of goods are going up all the time. And the impact for people is that they save less, and there's jittery in the markets also because more and more people are looking at, oh, today the prices are going up, tomorrow is going up, so do we want to hold goods? And the more people do that, the more volatile the economy becomes. So in this instance, we call it a very hot economy when inflation is high.
All right. Now let's switch to Paul. Paul, if you can hear me.
I can hear you.
All right. So Kojo has been able to talk to us about the effects on consumers and businesses. Now, if you look at Ghana as a country, we get a lot of remittance from this part of the world. So when these hikes are done, what will be the likely effect on remittance to our part of the world?
Like my colleague said, in order to fight inflation in the US, what this means is that credit card charges will also go up. And in the US, it's very common for people to live on credit cards.
That is, you can spend on credits from your bank and pay later when you get money into your account. So credit card charges are going up. What they buy normally. What it also means is that mortgage prices will also be adjusted. The rate of mortgages will also be adjusted. So people will pay more for housing and also for their daily expenses. And for a country like Ghana that receives so much from remittances of Ghanaians in the diaspora, in the US, for instance, what it means is that those people will experience an increase in their expenditures. And given that their expenditures will be catching up with their income, they may not be able to spend as much as they were spending previously. So what it means is that remittances to Ghana from the US will be going down or be reduced in the period ahead.
All right. Now, Kojo, if these effects are dire as you seem to paint the picture on the pockets of consumers and businesses, in terms of FDIs to our part of the world, what will be the challenge there?
I believe that in terms of foreign direct investment, like our colleague Paul rightly mentioned, Ghanaians abroad will be sending remittances, and I believe that is also the same thing that will investors will factor in when they are sending funds to Ghana. So, for instance, when there is headline inflation or inflation is really up in the UK or USA, what that means is that share prices tend, and when share prices fall, let's say, take for instance the share price of Apple or Microsoft. So Apple sells iPhone, and I will buy an iPhone, right? If I have money. But if the if the inflation is up, then investors tend to be jittery because they wouldn't want to be investing in Apple because Apple profits will decline because of the increase in cost of iPhone production and the price. So what will happen is that some investors, let's put it this way, would leave the share market, they will invest in gold, and some would go into safe havens. So for instance, if Ghana has lots of gold and mining companies, someone might be like, oh, I want to invest in a gold mining stock or gold mining company or a country that has a lot of gold. So in those respects, Ghana could benefit if investors are coming that way. But then, like our colleague mentioned, there's more to do with how much disposable income we have and do we want to go to Ghana, because at this moment, the exchange rates in Ghana are also quite volatile, and you want to invest your money in an economy where the currency is not stable. So we are in a catch-22 situation at the moment. And yeah, it is not all doom and gloom, but it's something that policymakers have to really adjust and make things happen.
All right. Now let's come back to Paul. Paul, so in this regard, if a country like Ghana that we're struggling with liquidity, it means servicing our debt, what would be the challenge, what would be the impact on our debt servicing ability once the interest is hiked over there?
So with interest being high in the US, what it means is that dollar-denominated debt instruments will attract a higher rate of interest. So going forward, if Ghana decides to borrow on the international markets, what it means is that we may have to pay more in terms of interest. So with high in interest, there will be shortage of dollars in the
Go ahead, Paul.
System, or the shortage of dollars, what that will mean that we may have people when we want to borrow on the international market.
And so what will be the challenge for managers of the economy as a whole? Oh, it looks as if we're having a challenge with Paul. All right, let me come to Kojo. Kojo?
Yeah.
Paul, can you hear me? Oh, Kojo? All right.
I can hear you.
Okay, good. So I was asking Paul about his line seems to have gone down. I was asking him about debt servicing abilities of frontier market like Ghana. If interest rates are hiked there, what will be the effects and what should be done to be able to weather the storm?
Okay, so two things. I believe that we've read in the news that Fitch and Moody's are actually, or they've downgraded Ghana's credit rating. So in instances like this, what that means is that for companies that need to service their debts in dollars, what they would do in our instance for Ghana, for instance, is that the cost of borrowing is very high. So if we go on the Eurobond market, for instance, we will be paying more basis points on the coupon that we are sell to investors. And so currently what Ghana is doing is that we are doing more CD denominated bonds. And once the government is able to sell, then invariably what the government has to do is now convert the CDs into dollars. So that has an impact on our currency also, because there will be more CDs chasing after dollars because we need to service the outstanding debt that we already have. So like Paul maintained, there's no way out of this situation because it's always you having more CDs chasing out after a few dollars, and the exchange rate will be volatile as is happening currently in Ghana. Yeah, thank you.
Yeah.
All right.
Just to add that, but I think I couldn't finish it, my point.
Okay, Paul, yes, go ahead.
Network. So like I was saying, now having lost access to the Eurobond market, to service our foreign denominated debts, which is more than half of our outstanding debts, we have to now raise resources in cedis or the local currency and exchange to be able to service our debt. And that will put further pressure on the cedi. As more of the cedi we supplied on the exchange market, there will be surplus of the cedi, and that will put more pressure on the cedi to depreciate.
So going forward, if you look at the Fed indication, do we see more hikes, or probably by the close of the year, inflation pressure could have been tamed down, and then interest rate might come down? Kojo, you can come in and Paul will come in.
Come again with a question.
I was asking on the outlook in terms of inflationary pressures and the interest rate hikes that's been done to tame inflation. Do you foresee by the close of the year central banks perhaps maybe trying to unwind the hiking, or they'll still stay where they are?
Okay, so for a developing country like Ghana, or for many other emerging economies, when interest rates are being hiked in the developed regions where the macroeconomic environment is more stable, there's more political stability, what it means is that relatively investments in the advanced country will be more attractive. And that can lead to capital flights from developing regions to the developed world. So under normal circumstances, you would have expected that countries like Ghana will also respond by hiking the policy rates so as to maintain the attractiveness of the locally dollar-denominated investments in Ghana. But with the kind of situation in which we find ourselves in, trying to revive the economy from the ruins of COVID-19, that wouldn't be the approach to take, or that may not be a good approach to take, because for an economy that is already on its knees, what you want to do is to invest more into the economy to revive the economy. And to invest more into the economy, you have to make access to capital affordable to businesses. And so therefore, it is not expected that Ghana will hike its policy rate in response to the hike in the policy rate by the federal government, the Federal Reserve Board of the U.S. So for Ghana and many other developing countries, it's expected that the policy rate will be maintained or even reduced so as to make capital more affordable for the business community and to enhance investments, create more opportunities for employment, and also expand the capacity of the government to generate more taxes in the medium to long term.
Okay, can I chip in?
Yeah, yes, could you go ahead?
So in our ideal situation, what Paul is saying is what we should do. But currently, with all the warmongering that we keep hearing in the news with respect to Russia and Ukraine, the outlook in the short term is that we cannot, as Donald Rumsfeld said, we are in the situation of unknown unknowns, so to speak. We don't really know what Russia will be up to next. And Russia being a a big oil producing country, for instance, that would lead to oil shocks where Russia to invade Ukraine, for instance, and being a country that is dependent on imports, for instance. Being a country that is dependent on imports, and most imports are priced in dollars, there's no any sight for me as I speak today, because we need to see how Russia will do things and how the pandemic would also pan out. So short term, we are in a good place if gold prices are going up, because Ghana is a gold exporting country, so we can make up any shortfall in gold prices that are going up. Thank you.
Thank you very much, gentlemen, for your thoughts on the impact of interest rate hikes by developed economy central banks on frontier markets like Ghana. My name is Edward Nyakun. God willing, come here with tomorrow. Shalom.